My name is Jade Solaiso, and I am super excited to stand before you this morning as your host and compare. So, we have a lot of activities lined up, as I mentioned, and I am happy to be your pilot. I promise you it's going to be a smooth flight. Despite the weather, there will be no turbulence. So, ladies and gentlemen, fasten your seatbelts and let us go through this wonderful journey together. Please have your seats. Thank you very much. The first phase of this very interesting flight is a quick peek into the economic outlook for the second half of 2024. To take us on this journey, please join me as I welcome my colleague Andrew Essene. Please, a round of applause for him.
Thanks, Jade. Welcome, everyone. I'll just run through our review of the first half of the year, the key drivers for um, the outcomes that we saw for the first half, and then our outlook for the second half of the year. Okay. A brief touch on the global outlook. All right. The global growth for 2024 was projected to grow by 3.1% and then 3.2% in 2025. This is higher than the initial forecast from the October report from the IMF, its World Economic Outlook report. So we've seen an improvement in the October 2023 numbers to 3.1% and an improvement of 0.2 percentage points. And it's really on the back of resilience we've seen in the US economy as well as other large emerging market economies, and how well the countries have recovered from the high inflation rate that we saw, close to around 9%, and now we have inflation sub 3%. So that growth has encouraged increased outputs, and that has informed the positive review we've seen in the 2024 and 2025 growth projections. For Nigeria, our 2023 numbers came in at 2.74% growth. The consensus position is that the economy will grow by 3% in 2024 and then 3.1% in 2025. We've seen Q1 numbers come in at 2.98%, and it was indeed an improvement from Q1 2023, which was around 2.5, and though lower than what we saw in Q4 2023 at 3.46, but that was expected because that was the last quarter of the year and there are increased economic activities at that time. How did the financial markets react to this, especially for global equities? Though there was a hike in rates to curb inflation, the anticipation that in no distant time we will see a reduction in those rates caused investors to still play in the equities and commodities markets. We saw, apart from the Shanghai Composite Index, all other major global indices close positive in the first half of the year, with the Nigerian All Share Index even performing very well, returning about 33% for the same period. Okay, major drivers that have pushed conversations in the global economic space. The Israeli Gaza war is still on, despite increased efforts to ensure a resolution of the conflict, but we see that is still raging on, and there are even new parties coming in, and we are still going round and around the same circles, and things appear not to be abating at this time. We've also seen in Africa an increased number of coups in the African region, with the ECOWAS regional body not being able to curtail that particular spread. And now we are even seeing a new regional bloc come up from the nations that have suffered that fate. Then the persistent Russia-Ukraine war is still ongoing, and maybe when we have the fireside chat, we'll see if there's anything in the horizon that could curb this. Maybe a Trump presidency will be able to douse these tensions in the region. Recent domestic developments for us in Nigeria, we've seen a significant wielding of monetary policy tools by the new CBN to be able to rein in inflation, curb the volatile naira, and then go even beyond its boundaries to see how we can rein in rising food prices. That has led to looting and social unrest that we have seen, and there is this loud cry from a large part of the population concerning where food prices are. Food prices year on year have grown by over 40.5%, the last numbers from the Office of Statistics. And so monetary policy tools being used to attack structural issues is what we've been seeing. The Naira crisis, spiking inflation, leading to minimum wage demands, and though labor is asking for a figure that many will consider to be outrageous, they have, to some level, been able to defend what they are actually asking for. Okay, for the economic aggregates, we'll just quickly run through them. So like I said, Q1 numbers came in at 2.98%, largely driven by the service sector, as usual. Other contributing sectors were agriculture, trade, telecommunications, petroleum, and natural gas. Going into the second half of the year, we are looking at a possible slowdown in the growth rate due to inflationary trends, which has affected consumer demand and also production costs from the real sector. NPR, we saw a significant jump up to 750 basis points in NPR throughout the first half of the year, currently around 26.25%. And the Alhaji Dangote was in the news just a couple of days ago saying that this rate was actually stifling the real sector of growth. But the CBN has come out to say their target is inflation. And so even though inflation appears to be moderating at around 33.95%, maybe we'll see a peak in June, July, but I'm not sure what we are targeting. Are we really targeting inflation, or are we keeping rates at those levels just to be able to ensure no foreign inflows and grow our foreign reserves? But that's where we are with NPR at this time. Inflationary rate, like we said, currently at 33.95%, and we see that there's a moderation in the growth rate, so it's increasing at a reducing rate. We'll likely see a peak around June, July, and then see if the CBN would, if we'll see a reduction in NPR to guide this. But the expectation is that with food inflation at 40.5%, we may still see another rise for June numbers when those come in. Another driver for that is the depreciation of the Naira. When we see the current FX rate, we'll see how we've seen a 19 and 33% depreciation of the Naira, both in the parallel market and also in the NAFEM. So that is it. The parallel markets for first half suffered a 19.74% decline from 12.20 to 15.20, while the official market suffered a 34.33% decline in inflation rate in the FX rate from 9.88 to 15.05. We did see a high for the parallel market of up to 18.80, and the official market did go as high as 16.65. Going forward with our improved FX levels and where the NPR is, we may be able to see, we could see some stability in the FX rate going into the second half of the year. Okay, the fixed income market. The performance of the fixed income market largely rides on the back of what we've seen with the NPR. And so in a bid to ensure real return for investors, we've seen an improvement in system liquidity. We've seen increased activities in the fixed income space, with yields rising from single digits to high double digits in terms of yields. And then even in the auction, we've seen auction rates very attractive, and we see investors playing at the lower end of the curve, just because almost every auction is expected to match what we've seen in the MPR. So new auctions are coming out and investors are positioning at the shorter end of the curve just to be able to take advantage of where the rates are coming in at. That's really the whole story for the bonds market, the T-bills market as well. I'll skip to the equities market. The equities market for the first half of the year returned about almost 40%. We had a peak in mid-February where the market was at 41%. So though the market is positive, around 33%, we are actually seeing a decline from the peak that we experienced. And the decline is being caused by the bank capitalization requirements. So investors are beginning to look at the dilutive effect the recapitalization will have on their position, and we saw a decline in the banking space. The consumer goods space recorded significant FX losses, and the likes of Nestle, Cadbury, Unilever, and the rest of them. We saw reduction in their prices, and then the increase in MPR by 750 basis points made the money market and fixed income market a lot more attractive. So that's where we are currently. The equities market is looking down because the focus is moving to the fixed income market. For the top players for the first half, the top loser was VFD, although we will have to discount this because the drop in the price was really as a result of a bonus issue that the company did. They did a 1-for-4, and that was reflected in their price. So it will actually be from Darcom down, and then on the top gainers list, we had Julie, penny stocks, a penny stock that gained over 1,500%. So for those that are looking for opportunities in the equities market, we see what the equities market returns are for specific stocks. And these are not just penny stocks. We have the likes of Geregu, we have Danksem, Julius Berger, Presco, Boa Foods. Good names are also pulling their weight in the equities market. Key factors that have driven the performance of the equities market, we see initially there was a spike in the interest for banking stocks. So coming from the Santa Claus rally of 2023, that fed into Q1, and that's where we saw the market really inch up to the plus 41% that we recorded initially before the downturn. And then there was increased interest in new listings, even though some of these listings were in 2023, but we did see that going into 2024, there was still increased interest in them, and a lot of them maintained very high prices, even coming into 2024. Dangote cement rose significantly, and that was what impacted the industrial index. It rose from around 330 to around its current price of 656. So that significantly moved the index, also giving it weight in the all-share index. Q1 is where we see the release of full-year numbers for 2023 and the dividend benefits that investors will enjoy. So that's also significantly impacted the markets. While the banking sector benefited from FX gains due to the depreciation of the naira, the consumer goods and industrial goods space suffered. They were the negative side of that move, and we saw significant dip in the price of those in price of companies in that space. So from going into half year, what we expect is that traditionally the market follows a pattern, and this data is from 26-year, it's our 26-year average of the performance of the NGX, and this is what the market normally does. So we will know from here, the first quarter of the second half, that the index will trend downwards, and that is because we are coming from a high of even the high from Q1 that has fed into Q2, and because of the absence of market news, so to say, we expect the index to trend downwards, and that will provide opportunities. We see for the 26-year average, the months of July, August, September were all negative. For 2023, it was different because this is when we saw the inauguration of the Tinubu presidency, and he made comments concerning removal of subsidy, and then the CBN came and harmonized the FX rate. And so that's why we see a positive return for 2023. But we expect that we may go back to the normal trend for Q3, and we expect the index to trend down. this is the canvas. What we would want to add to this is that now the banks are coming out to recapitalize, and so speculators are hoping that there will be that artificial hand that will raise prices so that the banks can come and say we are offering our rights issue or public offer at a discount to the market. So speculators are hoping that that would happen. If that happens, there may be a distortion in the expected trend for this time. So the drivers are, the market is trading from an overbought region, and then our strategy is also there. Then when we see a bottoming out around September, October, because there is no news here, investors would normally wait to see Q3 numbers, which will come out in October, November before they position, and that is why we see this positive ride in the market at this time. And this is what initiates the Santa Claus rally that goes into the December and then into the new year. All right, thank you. So that's just a brief of our economic review for the first half of the year and what we think will happen in the second half of the year. But to give meat to all that has been said, we want to invite a key personality in our midst, Dr. Afolabi Olookere, for a fireside chat on the discussion we have just had. Please put your hands together for him as he comes forward.